Hello friends, come to question number 14 of AS25. So our topic for today would be the tax expense in the interim financial report. So come to question number 14. An enterprise that reports quarterly earned rupees 1 lakh profit before tax at the end of quarter 1 and 1.5 lakh profit before tax at the end of quarter 2. The annual profit estimated at the end of quarter 1 is 4 lakh and at the end of quarter 2 is 5 lakh. The company had a carry forward of loss of 1 lakh at the beginning of the year. No deferred tax was recognized in respect of loss carried forward. The applicable tax rate is 40%. Compute profit after tax for the quarters. Compute profit after tax for the quarters. So now what I'll do, I will explain. Quarter 1, first I will compute estimated taxable income. Estimated taxable income of the first quarter will be 4 lakh is your estimated income. 1 lakh is carry forward loss. 4 minus 1, 3 lakhs. And estimated tax liability will be 40% into 3 lakh. That will come to 1.2 lakhs. That will come to 1.2 lakhs. So what will be my weighted average effective tax rate? Weighted average effective tax rate would be 1.20 lakh divided by my estimated normal income 4 lakh. 1.2 lakh divided by 4 lakh. The answer would be 30%. So my tax expense for first quarter will be, your income is 1 lakh multiplied by 30%, and that will give you 30,000 rupees. 30,000 rupees, or you can say 0.30 lakhs. 30,000 rupees or 0.30 lakhs. So this would be your tax expense of quarter 1. Now I'll go to quarter 2. My estimates will be revised. My estimates of taxable income gets revised. Now my estimated taxable income will get revised. Now they are saying it is 5 lakh is your estimated income. Carry forward loss, this is not changing. So my estimated taxable income will be 5 lakh. And therefore my estimated tax liability will be 40% into 4 lakhs. 40% into 4 lakhs will be 1.6 lakh. And my weighted average effective tax rate, weighted average effective annual tax rate at the end of quarter 2 will be 1.60 lakh divided by 5 lakh normal income. That comes to 32%. That comes to 32%. I hope this is right. That comes to 32%. Now we'll come to tax expense for quarter 2. Tax expense for quarter 2 will be, what is my total income of quarter 1, 1 lakh, quarter 2, 1.5 lakh. So 1 plus 1.5 lakh into 32%. This is my total tax liability of quarter 1 and quarter 2 minus tax expense already provided. This 30 lakh, 0.30 lakh in the first quarter already provided. So what you will do, deduct 0.30 lakh. So 2.5 lakh into 32% minus 0.30 lakh. So that comes to 0.50 lakhs. That comes to 0.50 lakhs. Is it right? Please check the calculation. Don't trust anyone except yourself. So 2.5 into 32%, 2.5 into 32% minus 0.3 is 0.5. So 0.50 would be your tax expense for the quarter 2. Now you will prepare profit and loss statement. Profit and loss statement quarter 1, quarter 2. Quarter 1 PBT is given in the problem 1. Quarter 2 is given 1.5 less tax expense 0.30, 0.50. Therefore, profit after tax is 0.70 and 1.0. This way the students are required to present the answer. Is it right? Is it understandable? Is it understandable? Yes. So that was my question number 1414. Please mark it as a very important question, and the student will have to solve again in the notebook as homework. I have written the answer myself, step by step, line by line, and this is how the student would present the answer. Now we'll come to one question from study material, May 11 also, for 4 marks. Question says, an enterprise reports quarterly, estimates an annual income of rupees 10 lakh. Assuming tax rate for first 5 lakh is 30% and the balance is taxed at the rate 40%. So slab wise system, estimated quarterly income are rupees 75,000, 2,50,000, 3,75,000 and 3 lakh. Calculate the tax expense to be recognized in each quarter. So first is my annual taxable income. Annual taxable income is 10 lakh. There is no deduction, there is no exemption, and there is no adjustment here. So we will take 10 lakh. Then I will compute tax expense. Tax expense, first rupees 5 lakh at the rate 40%, sorry, at the rate 30%, that comes to 1,50,000. Next rupees 5 lakh, next rupees 5 lakhs at the rate 40%, that comes to 2 lakh. So total tax expense comes to 3,50,000. Therefore, weighted average annual effective tax rate, weighted average effective annual tax rate will be 3,50,000 divided by 10 lakh, and that comes to 35%. That comes to 35%. Note, no change in estimations in other quarters. No change in estimation in other quarters. Now the next main task is calculation of tax expense. Calculation of tax expense for each quarter. So this is quarter, then you will write profit before tax, and then you will write tax expense at the rate of 35%. So you have 4 quarters, and the income given is 75,000, 2,50,000. Can you see 3,75,000 and 3 lakh? Copy this income and now multiply by 35%. Now multiply by 35%, you'll get 26,250, 87,500, 131, 250, 1 lakh 5,000, 1 lakh 5,000, and for cross check take the total, that will come to 3 lakh 50,000, which is matching here. And I have written a note assuming no change in estimation. Assuming no change in estimation. Enjoy the tea. Those who want to copy can copy. Otherwise, the answer is already printed in the notes. So you can copy from the notes also. But this question was important. This question was important. Now we'll come to the answer printed by your institute. You can see they have done the same thing. Exactly same thing we have done also. One very important question, 16 number. This question number 16 was asked in November 2013 exam. So first you will read the problem and then I will read. So all of you read the problem on your own first. Read the problem. Read the problem. Don't look here and there. So now we are ready to comply with the listing requirement and other obligation. Quaker Limited prepares interim financial report at the end of each quarter. The company has brought forward loss of 700 lakh under the income tax law. Similar to question number 14, out of which 90% is eligible to be set off. So you can only set off 90%. You can only set off 90%, that is 630. So for us, the set off allowed to be deducted from income will be 630. 630 is the control number. No deferred tax asset has been recognized on such losses in view of the uncertainty over its eligibility for set off. So there is no deferred tax asset in the books. So forget the deferred tax adjustment part. The company has reported quarterly earning. They have reported. Understand the question. 700 lakh they have reported in the first quarter and 300 they have reported in the second quarter, and anticipated a net earning of 800 lakh in the coming half year ended March 2014, out of which 100 lakh loss will be in the quarter ended 31st December 2013. So third quarter will have a loss of 100, and third and fourth quarter together will have a net profit of 800, which means the income of the fourth quarter will be 900. So this will be my total quarter wise income. 700 plus 300 minus 100 plus 900. How much is that? So that comes to 1800. That comes to 1800. Your total income would be 1800 of the entire year. The estimated total income will be 1800, assuming that the estimates will not change. The tax rate for the company is 30% and a 10% surcharge. So my total tax rate will be 30 and plus 10% of 30, which is 33%. Okay. My estimated tax expense will be 1800 is our income, 630 loss will be set off. 630 loss will be allowed to be set off. 1800 minus 630 and your tax rate is 33%. So your estimated tax liability would be 1800 minus 630 into 33%. So that comes to 386.1 lakh. And therefore your weighted average effective tax rate will be 386.1 divided by annual income of 1800. So let us calculate. That is 21.45%. You are required to calculate the amount of tax expense to be reported for each quarter. Now you come to this table. This is our PBT at the top and tax at the rate of 21.45%. So the student will take calculator. The student will take calculator and multiply 700 into 21.45%. So that comes to 150.15, 64.35, 64.35, 21.45 in bracket and 193.05, and this total will match to 386.10. You can check the total. You will write a note. It is assumed that there is no change in estimates. It is assumed that there is no change in estimates. So whatever estimates have been made, including income and the deductions, everything will remain same for the whole year, and this would be your estimated tax expense for each quarter. So you can read the answer on your own. The answer is printed. Good student will today solve it as homework. Solve in notebook. This question you will not find in your study material, but it is an old exam question, very much relevant for the upcoming exam. Now we'll go to question number 17. Another very important question, number 17. An enterprise reports quarterly, earns rupees 300 lakh pre-tax profit in the first quarter, but expects to incur losses of 100 lakh in each of the remaining 3 quarters, having zero income for the year, and is governed by taxation law, according to which its estimated average annual effective income tax rate is expected to be 40%. So they have given you this average tax rate 40%. They have already calculated it for you. You don't have to use your mind and check how this was calculated. Is it right? Now the question is, calculate the income tax expense that is reported in each quarter. So don't have to compute estimated average annual effective income tax rate. It is already given to us. So I just need to multiply the profit or loss with that 40%. So these are my 4 quarters, and my income is 300 in the first quarter, 100 losses in the first quarter, and my weighted average tax rate is 40%. Therefore, first quarter tax expense will be right there 300 into 40%, 120. Second quarter will be 100 into 40%, 100 loss into 40%. Same thing, 100 loss into 40%. Same thing here also, 100 loss into 40%. And the total will be 0. The total will be 0. Only for this much efforts you are going to get 4 marks. Now we'll go to question number 18. Question number 18. An enterprise reports quarterly has an operating loss carry forward of 100 lakh for income tax purpose at the start of the current financial year, for which a deferred tax has not been recognized. The enterprise earns rupees 100 lakh in first quarter of the current year and expects to earn 100 lakh in each of the remaining 3 quarters. Excluding the carry forward loss, the estimated average annual effective income tax rate is expected to be 40%. Right here, compute tax expense of each quarter. Compute tax expense of each quarter. The question is, compute tax expense of each quarter. So first what I'll do, first I will compute estimated taxable income. Now each quarter income is 100. So 100 into 4 quarters, and you have a carry forward loss of 100 minus 100, 300, 400 minus 100, 300. Second, write down estimated tax liability. Estimated tax liability, the question says excluding the loss carry forward, the estimated weighted average tax rate is 40%, but we have to consider the carry forward loss also while estimating the weighted average tax rate. So 40% of 300, that is 120. And step number 3, weighted average effective tax rate will be 120 divided by 400. That 120 divided by 400 is how much? 120 divided by 400, 30%. So this is how I'll get 30%. I will apply 30% for each quarter. Quarter 1, quarter 2, quarter 3, quarter 4. And we are now trying to compute tax expense. They have given you PBT, which is 100 for each quarter. Figures are rupees in lakhs. Tax expense at the rate 30% would be 30 each, and therefore profit after tax, they have not asked you, but if they ask you in your next exam, then you can record 70, profit after tax 70. So this would be the answer of this question. The student can note down the answer, although the answer is printed in the book, but in the book they have only written tax expense. I have also written profit after tax. So this is the answer of question number 18. I hope you have noted. First, the institute have explained the weighted average tax rate, and then they have explained the tax calculation. Now the next part of this chapter is about difference in financial year and tax year. A company may have a financial year different from tax year. For example, financial year can be 1st January 2025 to 31st December 2025. That is financial year. And tax year is April to March. So tax year would be 1/4/2024 to 31st March 2025 and 1/4/2025 to 31st March 2026. So if I draw a timeline, this is my financial year, because accounting is done for financial year. This is 1st January 25. Then you will have 31st March 25, 30th June 25, 30th September 25, and finally 31st December 25. These are my 4 quarters. Quarter 1, quarter 2, quarter 3, quarter 4. These are the 4 quarters for financial reporting purpose. But it will have 2 tax year. It will have 2 tax year. This portion, 1st January to 31st March, this will fall in tax year, what we call 24-25, and the other 3 quarters, they will fall in the second tax year. So that we will call 2025-26 tax year. One financial year, but falling in 2 tax years. One financial year is one, but some portion of it falls in the first tax year and some portion of it falls in the second tax year. So what we'll do, we will apply 2 weighted average tax rate. For the quarter 1, apply weighted average tax rate. Okay. Applicable for tax year 24-25, and for these 3 quarters, for quarter 2, quarter 3 and quarter 4, apply tax rate applicable to tax year 25-26. So can we have 2 weighted average tax rate? Yes. If a financial year falls under 2 tax year, then we'll have 2 weighted average tax rate, one for first tax year and then for another tax year. So that is the concept of difference in financial year and tax year. So good student would have noted it down by now. Others must be enjoying the show. So enjoy the show, no problem. So let us read the note. I will read the note from your book. Other students can note down if they are genuinely interested in the topic and in the exam and interested in scoring a merit marks. So the note says when an entity's accounting year is not same as the tax year, this example on the screen, more than one tax rate might apply during the accounting year. More than one tax rate might apply. For example, here we may have 30% in the first tax year, and here we may have 25% in the second tax year. The government might have reduced the tax rate, or it might have increased also. Second point, accordingly, the entity should apply the effective tax rate for each interim period to the pre-tax result for that period. So we are going to apply 30% for quarter 1 and we are going to apply 25% for quarter 2, 3 and 4. So this is the note in the book. You can read the note, and now we'll take one question number 19. Very easy question. 19 number, important for exam purpose. I hope you have marked important. An enterprise financial year ends on 30th September. So underline, financial year ending date is 30th September and it reports quarterly. But tax law, as per tax law, the year ends on 31st March. So financial year is different, tax year is different. For the financial year that begins 1st October, ends on 30th September of year 2, the enterprise earns rupees 100 lakh pre-tax each quarter. So profit is 100 lakh in each quarter. The estimated weighted average annual effective tax rate is 30% in year 1. First tax year tax rate is 30%. The second tax year the rate is 40%. Now see what is happening. This is the financial year. 1st October is the starting date, then 31st December, then it will have 31st March, then it will have 30th June, and then it will have 30th September. So this is the financial year. This is the financial year. First and the second quarter will fall in tax year 1. Okay, they will fall in first tax year, where weighted average effective tax rate is 30%, and third and the fourth quarter will fall in second tax year, because the tax year ends on 31st March, where weighted average effective tax rate is equal to 40%. This is given in the problem. So the question is, compute the tax expense. Question is compute the tax expense. You have to write here, question is compute tax expense of each quarter. Compute tax expense of each quarter. Compute tax expense of each quarter. Okay. So now my answer would be quarter 1, quarter 2, quarter 3, quarter 4, Okay, and maybe you can add total column also. Profit before tax is 100 lakhs in each quarter. But the first and the second quarter, they have a weighted average tax rate of 30%, whereas the second quarter, third and fourth quarter, they have a weighted average tax rate of 40%. So what do I do? Tax expense. Here I will take 40. Here I will take, 30. 30% into 100. Assuming no change in estimates, and here I will take 40 and 40 because the weighted average tax rate have changed. So my total is 400 here, but my tax expense is 140. And if they ask you to compute PAT also, then the student can write PAT also. So that comes to 260. PAT comes to 260 for the whole year, assuming no change in estimate. Note, assuming no change in estimates. Assuming no change in estimates. Assuming no change in estimates. So please note down the answer. Those who are interested candidate will note down the answer. Okay. I hope you have done. Write nicely so that you get full marks. So everything is printed in the book. Now let us come to next paragraph 22. First year of interim report. You are studying AS25 right now. In interim financial report, this is suppose current year, and for comparison purpose, we also give previous year data. For comparison purpose, we give previous year data. But if in case of first year of interim financial reporting, you are preparing interim report for the first time. Last year you had not prepared interim report. Then figures relating to P&L account and cash flow statement are not required. That means corresponding figures of previous year is not required because previously you are not preparing interim financial report. So which two statements comparatives are not required? P&L account, cash flow statement. But you can give balance sheet of the immediately preceding previous year. So if my interim period is 30th June, quarter ended 30th June, first quarter, I can give a balance sheet of 31st March 2025 because this balance sheet is already ready. It was prepared for annual reporting purpose. But you need not give P&L account. You need not give P&L account for 3 months ended 31st March 2000 or 30th June 2024 because you had not prepared this P&L account in the last year. It will require a lot of time and efforts to calculate all the figures again. You have to open the previous year books of account. So one time relaxation is given. You need not prepare P&L account and cash flow statement of previous year if it is the first year of interim report. Now, before we conclude the chapter, there is a paragraph number 23 which gives you some important principle of recognition for some special items. Okay. In the interim period, recording certain transactions are little challenging because we don't have so much of time, and we will not do the same exercise, we will not take the same effort that we will take for annual accounting purpose. And that is why the standard in its appendix has given you some guideline for certain special items. One is gratuity or other defined benefit scheme. This is covered under AS 15. This is covered under accounting standard 15. So in the interim report, what will you do with respect to gratuity and other defined benefit scheme? Okay, like post retirement scheme, what you call post retirement benefit schemes. Okay, so the standard says recognition principle would be as follows: provision in respect of gratuity and other defined benefit scheme for an interim period are calculated on a year to date basis. Provision will be calculated on year to date, from the beginning of the current year till the end of that interim period, by using the actuarially determined rates at the end of the previous financial year. By using the actuarial determined rate at the end of previous year, because at the end of previous year detailed actuarial valuation is done. So take that and you make adjustment for significant market fluctuations since that time. So whatever important changes have taken place during that time, make adjustment for that, and for significant curtailment, settlement or other significant one-time event. So take the last year closing figure. Let us say my last year closing date is 31st March 25 and we are preparing second quarter interim report for quarter 2. So you will have to take the actually determined rates at the end of previous financial year. Take this and make adjustment on year to date for 6 months. If there are any significant curtailment, settlement or significant one-time event, give effect of that. Sir, what do you mean by curtailment, settlement, defined benefit scheme? You have to read AS 15. AS 15 is already covered, so you may like to revise it. Now we'll come to second type of special adjustment, which is called major planned overhauls planned for the later period. Major planned overhauls planned for the later period means repairs and maintenance, but major repairs and maintenance which will take place at the end of the year, in the future part of the year, not in the current quarter but in the subsequent quarter. Some companies, what they do, they undergo major repairs and maintenance towards the end of the year. Question is, should we make provision for planned repairs and maintenance? Planned means which will take place in future. The answer is no. No provision is required. Why no provision is required? Because there is no present obligation. There is no present obligation. It is only a plan. There is no obligation created here. There is no past event. There is no present obligation. So the answer is, if you are going to incur any planned expenditure in future, there is no need to make provision because there is no present obligation. There is no past event. Okay. So you also mention here, refer AS 29. Refer AS 29. Then we have come to third point, provision. Right here, refer AS 29. provisions, contingent liability and contingent asset. I hope you remember. So the statement requires that an enterprise apply the same criteria for recognizing and measuring a provision at the interim date as it would at the end of its financial year. That means you follow the same recognition principle which you will follow at the end of the year. Same principle which you follow for annual accounting. Same principle which you follow for annual accounting will be used for making provision in the interim period. Now the question is very important. Bonus. Are you going to make provision for bonus in the interim period? Are you going to make a provision for bonus in the interim period? Suppose this is my quarter 1 ending on 30th June, quarter 2, quarter 3, quarter 4. Okay. Are you going to make provision for bonus? Are you going to bring provision for bonus in the books of account in the quarter 1? Suppose you have told your sales employee that if you achieve the sales target at the end of the year, we have given a target of 500 quantity. If you achieve that, then we will give you a bonus. But whether they will achieve or not will be known at the end of quarter 4. We are in quarter 1. Should we make provision for bonus payable at the end of earlier quarter? The answer is yes, if following conditions are satisfied. The student will have to remember these conditions now. A bonus is anticipated. Anticipated means you can make provision earlier in earlier interim period. If, but there is a condition, if and only if. If and only if means you have to be very careful about the provision. Okay, you have to be very careful about the provision. When you are 100% sure that these two conditions are satisfied, then make the provision. The bonus is a legal obligation. First, it should be a legal obligation like payment of bonus act, or an obligation arising from past practice, or it should be constructive obligation. It should be legal obligation or it should be a constructive obligation for which the enterprise has no realistic alternative but to make the payment. So in short, there must be legal or constructive obligation. Constructive obligation arises from past practice. For example, you are paying Diwali bonus every year since last 15 years to all your employees. Now you have created an expectation in the minds of employees that the company is going to pay Diwali bonus. Employee gets bonus for rendering services for the whole year. So in the quarter 1 also he has rendered the service. So proportionate bonus should be recognized in quarter 1 also. Some proportionate bonus should be recognized in quarter 2 also. And the second condition is a reliable estimate can be made. So the summary is provision for bonus can be made if there is a legal or constructive obligation, and if reliable estimate can be made, then proportionate provision for bonus can be made in the earlier quarters. Next is intangible asset. So you should mention here, refer AS 26. That's it. If you have studied AS 26, then whatever principle of AS 26 is applicable for annual reporting, it is also applicable for interim report. Principles applicable for annual reporting, applicable for interim reporting also. That is the shortcut to remember. Nothing different. The definition of intangible asset will be the same. If an item is not to be recognized as intangible asset for annual reporting, it will not be recognized as intangible asset for interim period reporting also. Okay. So nothing great in that. This point already covered. Other planned but irregularly occurring cost. Example, training cost. Company wants to incur training cost in future. Company is in quarter 1. They want to provide training to employees in quarter 4, which will result into heavy expense. Should they make provision in the earlier quarter? The answer is no, because there is no present obligation. There is no present obligation and there is no past event. So do not recognize provision. Do not recognize provision as there is no present obligation. As there is no present obligation. So any expected cost to be incurred in future which the management is planning will not be provided for. Now comes to contractual rebates and price changes. Contractual rebate means discount to be given to customer. Discount or rebate to be given to customer. You have promised to your customer, if you buy more than 1000 quantity, we will give you discount, but not now. First you complete 1000 unit and you have given him 1 year target to achieve that sales target of 1000 unit. You may be in the quarter 1. In quarter 1 he has not achieved that target. Are you going to make a provision for discount and rebate that you have promised to your customer? So the answer is volume rebates or discount and other contractual changes in the price of goods and services are anticipated if it is probable that they will take effect. Very, very important that you can make provision for discount, rebate if it is probable that they will take effect, because he has already purchased the goods. Okay, but final discount figure will be known once he completes the target. So in case if you are sure that this customer will be able to achieve the target, then the company should make provision for bonus. But it should be contractual. It should be contractual. There must be a contract between the supplier and the customer. If it is discretionary rebate, discretionary means at the discretion of the company. They may not. There is no legal or contractual binding obligation. Then they are not anticipated. So the summary of this paragraph is, if it is contractual, make provision. Make provision if it is probable. If it is probable. And if it is discretionary, then do not make provision. Do not make provision for discretionary rebates and price changes. Okay, because you can always withdraw from that. You can always refuse to honor the contract. Next point is depreciation. Depreciation will be provided only on those assets which exist in the interim period. Depreciation will not be provided on those assets which will be purchased at a future date. Very simple. Existing assets will only be depreciated. Assets which are going to be purchased in future will not be depreciated before they are purchased. And what about inventory? I won't explain much. Simply apply accounting standard 2. Simply apply accounting standard 2. What about foreign currency transactions, foreign currency translation gain or loss? Again, one liner. Simply apply accounting standard 11. What about difference in financial year and tax year? Already explained. In para 21 and question number 19. So you can read the previous page, para 21 question 19, where we have explained the concept of difference in tax year and accounting year. Is it right? So these are some critical points that they can ask you. Now, as a homework, you will solve question number 20, 21, 22, 23, 24, 25, 26, 27. Oh my God. So all these questions are there. Please solve them. Okay, they are easy. And I have already explained all of these questions during the course of our lecture. So your task would be just to read this question. These are very important theory questions. A plain reading would be enough. Already explained in the course of our lecture, so don't worry, right? So with this we complete this a very important accounting standard AS25. If you have any doubt, you can ask me. For doubt, you will mail me preferably at vinod_ca@yahoo.com, or you can send your doubt on WhatsApp number. You can store this number in your mobile 97669 21860. Store this number on your mobile and you can WhatsApp. When you ask the query, please write the query in detail. Otherwise we don't understand. Write the name of chapter and write question number, page number, photo of the question. Then it is easier for the teacher to understand your query and we will be able to reply to you. So thank you very much for attending Accounting Standard 25.